Let me ask you something that feels a little awkward to admit. If you're earning more today than you did a few years ago, why does your bank account still feel fragile? Not desperate or broke, just constantly tight. You're paying your bills, you're functioning, but there's this quiet sense that money is always one step behind you. For many people in the US and Europe, this isn't a personal failure, it's a pattern. Imagine a fairly typical situation. You're in your late 20s or 30s, you went to school, got a job, maybe changed jobs once or twice, and your salary grew. Let's say you earn $75,000 a year in the US, or about 60,000 euros in parts of Europe. After tax, that's roughly $4,300 a month hitting your account. On paper, that's solid. Then life shows up. Rent or a mortgage around $1,600, a car payment or lease at $420, insurance, utilities, phone and internet at $500, student loans or a personal loan at $350, and groceries and basic living at $600. Nothing luxurious yet, and you're already around $3,470. Then there's the quiet stuff, streaming subscriptions, occasional eating out, a few credit card purchases you'll handle later, and another $400 to $500 disappears. By the end of the month, what's left doesn't feel like progress, it feels like margin, and margin feels temporary. The hidden mistake most people don't realize they're making is letting fixed lifestyle costs rise at the same speed as income, not because they're reckless, but because it feels reasonable. A nicer apartment feels like growth, a newer car feels responsible, and monthly payments feel manageable. The system encourages this. Banks don't ask whether something helps you build wealth, they ask whether you can afford the payment, and those are very different questions. Take that $420 car payment. Over 5 years, that's about $25,000 gone with no leverage or return. If that same amount quietly went into a long-term investment, earning a modest return, it wouldn't feel dramatic month to month, but over 20 years, it could quietly grow into 6 figures, not because you were aggressive, but because you didn't lock it into a depreciating habit. This is what people miss. The cost isn't the payment, it's the future that payment quietly removes. Smart, educated people fall into this because humans adapt fast. When income increases, the brain updates what feels normal. Yesterday's luxury becomes today's baseline, and social pressure makes restraint feel like falling behind, especially when everyone else seems to be upgrading their lives. Debt feels harmless when everyone around you has it, and when the pain is spread out monthly, it doesn't register as danger, it registers as adulthood. If nothing changes, income rises, lifestyle rises with it, and financial stress stays exactly the same. You earn more but feel no lighter, work harder but feel no safer, retirement feels distant, and freedom feels theoretical, not because you didn't earn enough, but because every raise was already spoken for. People who eventually feel calm about money don't usually do anything flashy. They separate income growth from lifestyle growth, and when their salary increases, they don't immediately ask what they can upgrade, they ask what pressure they can remove. Less obligation, fewer fixed payments, more flexibility. They don't think in terms of status, they think in terms of control. Control over their time, their options, and their future decisions. That mindset shift doesn't make life smaller, it makes it quieter. If money feels tight even though you earn more than before, it doesn't mean you're bad with money. It usually means you followed the default path without questioning who it actually benefits. Awareness is the first real step, not guilt or urgency. And if this way of thinking helped you see your situation more clearly, you can subscribe to the channel for more calm, realistic conversations about money.